Welcome back, everybody, to We Are TPM, and Happy New Year for our first episode of the 2023 year.
Happy New Year.
You are back with Kyle Teixeira, myself, and sitting next to me, no longer across from me,
That's right.
John Teixeira. We are going to speak this week and teach you a little bit about real estate syndication funds. Now, if you have any questions about anything we talk about on this podcast, want to talk to us about real estate, how to build wealth, give us a call, 817-818-9039. Shoot us an email at ShowMeTheMoney at wearetpm.com. And if you really want to hear about a specific real estate syndication fund, we have one we're working on right now that we will be talking about at the end of this episode. So Make sure to stick around, and we'll get a lot more specific. So initially, you might be asking yourself, what is a real estate syndication fund?
Yeah, I mean, the first time I heard this, I didn't know what it was. It's not something that's that broadly, commonly used or is common knowledge, right? Google has definitely made it easier for people to learn about this kind of stuff, but even investors don't really know about it.
I'd say this, you got two ends of that coin. I'd say this one falls into the category of big money investors would know exactly what you're talking about. It's one of those things that might feel exclusive, but in reality, anybody can do it, right?
Yep.
Anybody can do it. It's very commonly practiced, less commonly talked about. It's one of those things, too, that investors don't really talk about the funds that they're involved with or where their money is. It's one of those things. So
they're usually exclusive, right?
Yeah, I mean, they are exclusive, and they're private. So in a general sense, a real estate syndication fund is investors group together their money, or take that step back. You have a sponsor, so you have an operator who's going to go out and get a property, acquire it for the purposes of making a profit, right? And they create a fund to fund that project, or get a group of investors to put their money in to fund the project for the goal of splitting the profits.
Okay, so before we move on to investors, so big picture, sponsors are basically putting the deal together.
They put the deal together. They're asset managers, and they're either operators or hiring the operator. All the operations of the deal are handled by the sponsor.
So if I want to put together a syndication fund and I want to be the sponsor, I would be responsible for finding the deal, putting the deal together, selling the deal, or acquiring investors for the deal is what I mean by selling the deal, managing it all the way through till whatever strategy that fund has, right? It could be an exit strategy, it could be a long-term play, and we'll talk a little bit about that. But, I mean, the bottom line is if I'm going to be a sponsor, then I'm in charge of all of it from the very beginning, from the inception and origination idea all the way to the very end, right?
Correct, and we're, just to be clear, we're talking about this in a very it's a very unstandard industry, I would say, but this is
is unstandard a word?
Yeah, I don't know. No, non-standard.
Hey, can you look that up for us, Steve? Is that non-standard?
Okay. But in a general sense, this is the generalized way these things are structured, because you can really do whatever you want with these. But yes, the sponsor is generally responsible for all the control of the project after the money is posted. Closing the deal, all of it. So they are in a easy sense, the operator of the project, making the investors the limited partners. So a lot of these, people probably have heard how a lot of partnerships are structured. So another way to say this is you have the general partner, who's the sponsor, and the limited partners, who are the investors.
So if I were to simplify this, in order to make a deal happen, this is where syndication comes from. You need people with the time and expertise to get the deal done, and you need money. Almost every real estate deal out there needs those two things.
Yep.
So this syndication is kind of a marriage of those two things. A syndication fund, that's what we're calling it. That's kind of the legal, not legal, but that's the industry name for it. But there's a lot of different ways that you can do this kind of syndication. We've talked multiple times about partnerships that we have is basically this same marriage of expertise and investors, because
but it's not the same. So, and you might be thinking, what's the difference between grouping all my friends together, getting some money, and buying a property and having it managed. Well, the control aspect is what makes this syndication fund. So the incentive, right? So the sponsor's incentive in these deals and drive in these deals is they get a piece of it. So for being the operator, let's use the example of 30%. It's in the industry, it ranges anywhere from 10 to 30%. It can be outside of that, but that's in general, it's 10 to 30%. So let's go with 30. Sponsor will get 30% of the deal. The investors will get 70% of the deal. And this is
to clarify right now, you're talking about equity.
I'm talking about equity. So This is equity in the deal. While say the investors, there could be instances where the sponsor puts up money, but say, to make this simple, investors put up 100% of the money for 70% of the equity. Sponsor does 100% of the work and operations for 30% of the equity.
So I buy an apartment complex for $1 million in 2022, and I have a strategy then, just to make something up, to do the syndication fund, rehab the apartment complex, and sell it in 5 years. And I do that in 2027 for $5 million. So my equity in that deal is $4 million minus expenses, right? Whatever my expenses were in those two transactions. So let's just call it $4 million for the sake of. So what you're saying is that $4 million equity spread and the exit strategy is now split in some certain way that's predetermined. And the example that you gave was a 30.
Yeah, we're gonna get into all of the things that are in between that, but what you're saying at the end, where there's a profit on that exit, the sponsor would get 30% of whatever the profit is.
Yep.
And the investors would get back the 70% of whatever the profit is. And that's after everything in between, operations and all that. So
love it.
But, essentially, having an operator means you don't have like a property manager, for example. They are your property manager. So that's where their operational aspect of it is about performance. So if you go out there and look for syndication deals or information on syndication funds, the number one thing you'll hear is you want to find accredited sponsors. The sponsor is one of the biggest pieces of this puzzle that matters, because if they don't hit their marks or they don't or get the returns from a deal that should be, or that they presented at the beginning, that's where you have
it's credibility.
Yeah, it's credibility. The sponsor doesn't make money. You don't make as much money. So, and one of the reasons for that is a common one we'll say is waterfall structure. So one of the deals we're going to present at some point is a waterfall deal. And the way that is structured is there's a whole bunch of ways you can structure a waterfall deal. But basically what it means on the high level is when you have profits, they go through this waterfall before they get to the equity split. So, consider the equity split at the bottom of this waterfall. That's where your split we just described, the 70-30. Well, I start with a profit at the top of the waterfall, and a lot of times to give investors some assurances, you'll have a preferred return.
Can we change a word, one little word in that might make it easier to understand?
What?
Revenue? No? Revenue instead of profit?
No.
Net revenue? Something?
It's profit. I mean,
because the reason why I say that is because when I think of profit, I'm confusing. Some people are going to confuse the the profit of equity that's shared at the exit strategy when you maybe sell a particular property. Now, if you've got a fund that has a whole bunch of properties in it, then there may be some of that in the middle of it all, right?
I say profit because it's defined by the operating agreement. It's really, if you were a long-term management thing, it'd be your cash flow, your monthly profit. But profit's defined by whatever strategy it is. You could not. The strategy could be to not touch any of the money until the exit. The strategy could be to distribute every quarter, distribute every year, distribute the cash flow every month. So it makes it more general to say profit in that sense. It could be to hold all the cash flow profits in an account until the sale, add all those profits to it, and until that 5-year exit, nobody gets anything, right? So in these deals, it's very important to know the details of whatever the operation is, and that's why I'm saying profit, because the profit at the end of the day is what gets waterfalled back. Because if you're not making money, there's nothing to waterfall down. It's the tip of the waterfall where it starts to pour back down is your break even, right? It's whatever time period, monthly, quarterly, yearly, where your break even is, and then the rest flows down. So, and a lot of times the preferred return is the first flow. So what that means is like, say you have an 8% preferred return, which is common. At an 8% preferred return, the investor, say they put in $100,000 into the deal, 8% of that, the money they're into the deal for, would be $8,000. So if there's, let's say, $20,000 of profit, that $8,000 is the first thing to go back to the investor. If the profit's only $4,000, the $4,000 goes back to the investor, but none of it continues down the waterfall. But in this example, we're going to use 20. So you have 8,000. And then under that, say you have an asset management fee to the sponsor of 1% that guarantees the sponsor 1% of the value of the asset. We could go with say this was a $500,000 asset. 1% of that's another $5,000. So now 13,000 of it's gone in the waterfall, and it goes down to the next one. Assuming you don't have any performance targets, there's a lot of things that could be done for a sponsor to have performance targets under that, which is common. We're just going to keep it simple and do the next one just goes to equity split. So of that 7,000 remaining, you have 30%
that's that
of
70-30 we talked about as an example. That's that split, right?
Yep. So you have 30% going to the sponsor, 70% going back to the investor. And you can see how the better that performs, the better both do. Once you get down to your split. And say the value of that asset goes up, the better they both do. So that's one of the most important pieces is performance at the end of the day. So these are most common, like you said, in commercial deals and like apartment deals, because the way they're valued is based on the operations and the performance of those operations. So that's where these makes these a lot more incentivizing in deals that involve commercial real estate. And you'll see them way more commonly in there.
Yeah, and they'll all have different purposes. They'll have their own purpose. Each fund will, right? Like we've seen a lot of funds that are buying up houses like crazy, right? So I just was under contract with one of these funds for one of our houses that we manage. That they're buying, they buy 30 houses a month in DFW, and they probably buy in other markets as well. And that's the fund's goal, is to buy and hold, right? So every fund has a different purpose.
There's funds that have requirements, most do, like how long till you can pull your money out, or when's the exit, or when's the refi, or whatever it may be. The one you just described is probably a minimum 8-year, I'd say 8 years at least, that the investor has to keep their money in there. There's funds that could be 8 months. There's funds that could have a 5-year return plan, 2-year return plan. It all depends on the strategy of what this sponsor intends to do with the fund money and what plan they've laid out. So, but a huge reason for this, and the reason we're talking about this now, is these become more common and more, they work better. Or not going to say they work better, but people start looking for these more in high interest rate environments that we are going into right now. Asset values have gone up a lot in the last couple of years. Interest rates were low. It was easy to get conventional financing. Now that that's less accessible, these deals for the most part, involve mostly cash.
So let me ask you. So we kind of, I think we skipped over that a little bit. We skipped over an investor's role. Like, how do investors? We have sponsors and investors. Where do we find these investors, and how do they get involved?
That's the thing. It's private funds.
Mhm.
It's all private. So in any way you can think of. I mean, it's where you have to be careful and know what it is. And I'd say there's sites, there's marketers that'll push these things around. But like we're gonna present one here later. That's how they get involved. You have to.
Well, I just mean
it.
in a real general sense, Kyle. I'm just trying to share with our audience that these investors can be anybody, right? With any amount of money, right? We could get Steve if he's got $10,000 extra dollars he wants to throw into the fund. In some funds we can do that, right? There's probably a minimum in some funds, but there's some that don't. But Steve's ready to write a check over there.
It's all up to the sponsor of the deal. Or like, say, for example, we could have $100,000 house. I could go get $1 from 100,000 people.
That's right. That's
would that
my
make
point.
sense to distribute, 8 cents to 100,000 people? It would probably cost me more money to distribute 8 cents to 100,000 people. It has to make sense. A lot of people sell it in chunks. Like, say you have a $100,000 property, probably send them in. At
five 20,000 or something like that.
I'd say $10,000 splits, because you also have to remember you're trying to make all of those people happy, right? As a sponsor, you're dealing with as many people you allow into the deal. Most of the time it's a limited / silent partner, but to some extent they're involved. They have to at least be reported to and know what's going on. Do you want to report a $100,000 deal to 100,000 people, or are you going to look for 10 people or 5 people? So a lot of the times they're sold in chunks or with minimums. So you could say a minimum of $20,000 to get you in. You could have someone come in and say, I want 80,000. I want 80% of that. So,
or they can buy the whole fund if they want.
Yeah.
Like the one we're going to present, somebody that would be open to somebody not at this point, but I mean.
Well, and there's funds that have maximums too. And the reason for that is so that there's always control aspects at any deal. And maybe they don't want people to be able to take over a majority of it, so it's really looking at the details of any fund, any deal is very important, because someone could throw out, everyone does 8% preferred returns and give an 8% preferred return and not look at the rest of the waterfall or rest of where the profit and revenue goes. So, and a lot of them do talk about net revenue. So I appreciate that he tried to change the word to that. It's just, I was being high level that it could be a lot of different things, because there's funds that'll lock up your money for years too. So if it's a development fund, there's a lot of development funds out there that are going to spend 3 years developing something and then selling it. Right. So those are solely based on profit. It's a negative revenue.
Those build to rents that they're doing neighborhoods right now are those funds. They have a strategy.
There's big money deals that guarantee a certain amount back or guarantee your buy-in back or whatever, but it just depends. But we bring this up because
Can I re-articulate it?
Yeah, go ahead.
So, because you know me, I'm all about simplifying things for the dumb guy like me, right? Because sometimes I have a hard time wrapping my brain around these things. And just because I'm in this world and we're talking about it and doing it all the time, still it takes me a while to figure this stuff out sometimes. So I feel sorry sometimes for the person might be listening and is thinking like me and doesn't. So if I could re-articulate it, I would articulate it this way. This would be a fund where anybody can invest a certain amount of money into, right, that they can afford, right? You've got a sponsor and you've got usually multiple investors in these funds, okay? And they are given in the waterfall type of fund that we're focusing on and talking about, they're given a guaranteed rate of return for their money, which is what people are thinking about. When people are thinking about, what do I put my money in? Do I put it in an IRA? Do I put it in the stock fund? Do I buy a piece of real estate? People are always thinking in terms of rate of return. Well, that's what this fund should be giving you, is a guaranteed rate of return, right? So first thing is investors get a guaranteed rate of return, so everybody's happy right off the bat, right? Then this sponsor gets something from putting this whole deal together, but they're second, right? They're second in line behind the investors in case they don't perform. Am I on track?
Yep.
Right? So it's up to the sponsor to put together a deal that will perform. Otherwise, they don't get paid, right? They don't get any portion of their money. And then after that, hopefully you perform so well that there's still more left over to split amongst that equity split you talked about in the example we gave was the 70-30. Then you split that kind of at the bottom, right? Afterwards, right? Mm-hmm. So it's a structure that kind of keeps everybody honest on their toes to put together good deals, right? And not make, I don't know. It's not something you just put together easily. So it's not something you're just going to do on a whim for, something that's not going to work, that has question marks, I want to say. Does that make sense?
Yeah, it makes sense.
Did I re-articulate that okay for you?
Yeah, I mean, you did. You didn't make it as completely simple as you said you were going to, but
well, I tried.
So, and one of the specifics that go into it is people are like, well, okay, I found this fund. What do I ask for? Well, there's a pro forma usually that is something that presents the deal in a way that shows us how it's going to perform. And then there's a commitment phase where you commit to it, and then they have an operating agreement that brings you in and creates this partnership. So that's really what you'd be looking for in a syndication fund. So and the way that we bring up waterfall because you could change all those things to make it very investor friendly, very sponsor friendly, so finding that middle ground in a deal that actually is fair is I think is the most important piece, because you don't want something to be too sponsor friendly or too investor friendly. At the end of the day, you want
win-wins are always winners, aren't they?
We want it to be a win-win, or else there's too much incentive on one side or the other. So
I love it. The point really being that there is a ton of different ways to do these syndications, and we've just touched on like one, really, right? Like we can, and there's a whole bunch of ways that you can even do. Like to your point, there's a whole bunch of different ways you can mix and match all the different parts of it, right? To depending on what you're doing. I use an example of an apartment complex. You may put that deal together way differently than you would like maybe a single property, or I'm going to buy 500 single family homes. Like all three of those deals look completely different, and financially you would want your outcome and your results to be different in each one of those.
And one that we've been talking to our clients about recently is very new. Not many people, you can't even find many out there, but short-term rentals. And that's because it's kind of a mix between the two common ones, big single-family rental portfolios or commercial real estate, most commonly commercial real estate. Well, short-term rentals are actually valued, are usually single-family homes, but are operated and valued, especially to these funds, like a business, like a commercial piece of real estate. So the structures are very commonly, or there will be very commonly adapted to the commercial real estate structures, like these waterfall ones. So
there's no reason why you wouldn't think. Let's say if I had 20 Airbnbs or short-term rentals right next to each other on the same street, that's almost like a hotel, right? So there's no reason why you can't. There's no reason why you wouldn't evaluate that business like a hotel business. It's a hospitality industry. It's all the same.
I think I'd evaluate the deal like other deals, though, that it's, you'd probably want 30 Airbnbs spread out across the country. And that's the type of things funds do.
Yeah.
So,
I just
diversification.
Yep.
So, and this is one way to diversify. You can get a small piece of things in maybe different areas, or maybe you want to get into Airbnbs and you could buy one, or you could get 10 pieces of 10 deals, or one piece of 10 deals, with the same amount of money to diversify. So that's a very common way people diversify too. And sometimes they're even call it placing your bets on different sponsors or different operators by getting into different funds.
So, Kyle, a lot of the people that are going to take the time to listen to us probably know us, right? Or they've gotten to know us by listening to us or whatever. It's not like we have this, nationwide audience or anything. So, but if I run across one of these deals, I've actually heard them on the radio, advertised on the radio. So if I run across one of these deals, what do you think somebody should do to protect themselves from the first thing people think of is this might be a scam, right? We hear all the time how really wealthy people scam other really wealthy people. So how do I make sure as a small guy that my $50,000 doesn't get scammed and lost? Like what am I going to do to protect myself?
Well, first answer I'm always going to give on that question is the most generic. Talk to your attorney. Let your attorney review the paperwork.
That's a boring answer.
If there is no paperwork,
it's a boring answer.
It is a boring answer, but it's the answer I have to initially give. And then second, just credibility. At the end of the day, a lot of real estate and business in general is about relationships, right? Mm-hmm. So if they won't make one with you or talk to you about why they think they're credible for this deal and get offended by you doing credibility checks, that's always a red flag. What is your what makes you credible for doing this? What have you done previously? If it is nothing, why aren't you telling me it's nothing? Why are you trying to claim in general vague senses that you've done all these things, right? Like when we try to do these things, we can talk about our history as operators, and we've talked a lot on this podcast about our short-term rentals. We've given numbers about our short-term rentals. If you're afraid to be transparent about the things you can be transparent about, I said that's a red flag because it's hard.
That's such a good point.
It's harder to return $50,000 on $50,000 than it is to lose $50,000, right? So it should be a concern of yours before just throwing it places. But
I think once you learn, it's like anything else. Once you buy, a blue Tesla, then you start seeing how many blue Teslas are out there, right? And so once you learn about syndication funds, you're going to notice how many there are out there. There's a lot of them, right? There's a lot more than you realize. You never had a blue Tesla before, so you never noticed them. And so that's what I mean is really like, I hope people, this is a very unregulated type of industry, right? Like it's regulated to some degree, but.
Well, I think it's important to know, or at least for us to state, that there is different structures of funds, and some of them are regulated by the SEC. So I'm not going to specify or get into where the differences are because you definitely need to research yourself. But if in the ones that aren't, in the ones that are private, you aren't a quote unquote completely silent partner. You will have some say and some input, and if you don't, then it's probably regulated by the SEC. So but regardless, people do what people do, and a lot of, especially in Texas, a lot of real estate contracts and deals and prices and all that stuff is still private information. So do your due diligence and make sure there is an agreement, and the credibility and background of the sponsor is your number one thing. If they don't have any, or they are admitting to being new at something, maybe the lower split should be what they take to gain credibility. And on the same note, making sure the deal works in your favor with that risk difference. You in any investment, you balance risk and reward. So if you're taking a bet on a new sponsor or an uncredible sponsor that maybe, not saying you don't trust them, but maybe you don't have enough information to know you can trust them, then should you be given more reward incentive for taking that higher risk?
Yep. Love it. That's a good point. Really good point. Is there anything else that people need to know about syndications?
Oh, there's
a lot
hundreds
to be
of things you could do. So, there's probably syndication funds that have a waterfall that goes 14, 15 points down, but to keep it simple, you shouldn't overcomplicate it, in my opinion.
Keep it simple.
The people who if there's a sponsor making something very complicated that it doesn't involve hundreds of millions of dollars, maybe it's complicated on purpose. Maybe it's complicated to make it complicated. So, simple. To keep it simple, the sponsor should be incentivized in a very simple manner to perform on the goal, the strategy, and you should have a very simple outline of how you are going to get rewarded on
Love
that same
it.
strategy. So
Love it.
that's the simple part.
So Kyle, I'm really excited. Can we introduce people then to our list week?
Why not? Let's tease them a little bit. So, if you've been listening a while or you've seen previous episodes, we have two short-term rentals that we've been managing and
I got 3. We got 3.
well, I'm talking about in this complex. We have 2 that we presented a couple months ago, numbers on and specifics on. We did it in a general sense, but in Orange Beach, Alabama. So Orange Beach, Alabama is one of the markets we are operating on. And to get everybody, we're going to be sponsoring, or we are already sponsoring, a syndication fund for a third unit in that same complex to be, that it's actually better than the other 2. That's why we're so excited about it. But we're going to be presenting that one throughout the next week, but specifically, I don't know when this is going to release, so maybe this week, but Friday, the 13th, we are going to be in Orange Beach, Alabama, and presenting live from Orange Beach the syndication deal. So to get investors excited, might be on the patio. You can not just see the unit we're going to be operating, but we'll be in it.
And we clearly haven't formulated exact time and date yet, but we might do it Friday and Saturday, so we can do it at night and do it during the day in the middle of the Saturday, so people see what the complex is like on a Saturday. It is in January, so it's not in the middle of the summer or anything, but
show you how beautiful it is to be able to still use it in January.
It is so gorgeous. I love going there during the winter. I love going there during the winter just as much as I do in the summer. So I'm so excited to introduce this to everybody. And if you're listening to this and you have any interest at all in a vacation rental, a syndication fund, or Orange Beach, tune in next week. If even if you have no plans to invest or no money to invest, you might know somebody that does. Tune in, because we're gonna have fun presenting
or
this. Or
call us the second you hear it. We've still been presenting it. It's only been word of mouth to this point.
Yep.
We're not going to get into specifics right now, but we will if you give us a call, 817-818-9039. Ask for Kyle, ask for John. We're the ones syndicating it. But it's going to be a fun one.
Or they can send an email, right? Where's that?
ShowMeTheMoney at wearetpm.com. We plan to present a lot more about the future opportunities of Summer House, of Orange Beach, Alabama, what's coming up there, why this is going to be not just an exciting investment, but a great investment. That's why we want to get people in on it. We were feeling stingy on the other 2, not getting people in. So this is
everyone's been hammering us a little bit, haven't they? Like, why? How do we do this?
How do we get in? Well, we used that inspiration and questions to find a way and create this syndication fund to get people in. So if you're interested, you want to talk to us, property management, syndication funds, anything real estate, give us a call, 817-818-9039. Shoot us an email, showmethemoney at wearetpm.com. Come see us in downtown Mansfield. We'd be happy to get you excited about this face-to-face. And thank you all for tuning in. See y'all next week.
Later. We out.